Hey, good afternoon, everyone, and welcome to another Andrew Rose financial educational video. Today, we're going to cover investing and more specifically talk about target date funds. So, we're going to pop the hood on what they are, how they work, and then also in segment number 2, we're going to talk about how they work and perform to get you through retirement. So, a target date fund is essentially a mutual fund investment. You've probably seen them in your 401ks or your IRAs, and you might be invested in them yourself. A target date fund was created in the 1990s and really became popular in 2006, as you can see on the slide and to show the growth of assets in target date funds. Now they make up the majority of retirement plan assets. This is due to them being a qualified default investment alternative, meaning if you don't pick your investments, you're automatically going to be invested in these. Target date funds, though, are right for the right type of investor. So, how do they work? Target date funds will work down a glide path. So what that means is while you're young, early in your career, you're going to be more in equities, somewhere between 85 to 95%. And as you get older and your account grows over time, you're eventually going to get to a point where the managers moves more of your money into bonds and cash, which fluctuate less. And the principle is to protect your principal. That is a belief that going back 70 years in retirement planning has had some good merits. So looking at a couple options, the important thing is every manager or mutual fund company operates on a different glide path. So as we can see, we've got an example of Vanguard's target date fund, which starts out when you're 65 with essentially about 60% in equities. 10 years later, that's going to drop to about 50%. In addition, we've got American funds, another popular holding, and we can see their glide path is a little bit different. They actually have less in equities in retirement, and you can see they have less allocation to growth style stocks like Visa, Amazon, and Google, which historically tend to fluctuate more. So, a key thing with target date funds is they're generally low cost and they're usually a one stop solution for well diversified investing. So, for the right investor, they oftentimes make sense given if you don't have the expertise or time, it's a great way to grow money. Now, again, it does involve risk, and you should work with an advisor, or if you don't have an advisor, find one to really pop the hood on your target date fund so you know exactly what you're invested in. Give you an example, in 2008, 2009, the first target date funds, which were target date 2010, were being reviewed. Some were down -5% during that bear market or recession. Others were down -30%. So again, you don't want to be surprised and have a 30% fluctuation downward in your account right before you retire. Ouch. It's pretty painful. So again, know what you own and work with an advisor who's qualified to review this for you. Again, a target date fund can be the right solution, but it's not for everybody. Additionally, you should check your own risk preference to make sure it's a good, suitable investment for you. Just because you're 24 doesn't mean you might want 90% of your money in equities. At the same token, if you're 65 years old, you might be more comfortable having 80 or 90% of your money in equities. So check them out and please comment with any questions. In addition, don't forget to subscribe to the videos and come back next time. We're going to go through segment number 2 when we're going to look at the success and the risk of using target date funds while you're retired. Thank you. Have a great day.